gotta leave your money behind you. Raise your hand to the sky.
Hello, everyone, and welcome to yet another edition of Give Me Some Truth. And our topic
for expats.
For expats.
Or is this more of a whole?
This is a firm-wide Give Me Some Truth, Stan.
This is just absolutely just give me truth.
Yep, absolutely.
And some of it.
And our topic for today is a recap of Q1 market action. So what Stan and I wanted to do is just, have a discussion about what's been a pretty eventful quarter overall. Both in the sort of regular everyday global news and market news as well.
I just want to say from the get-go here that, like, it's April 1st.
Yeah.
It's April Fool's Day, so I be ready for anything, Syl. But more importantly, it's April 1st, and I am in such a great mood today because I know what you think I'm going to say, but you're wrong. Because it is no longer Q1.
Right. We're happy to be done.
It was like, we've been for a couple of years now, it seems like, saying, hey, look, it gets tougher from here.
Mm-hmm.
Well, it hopefully doesn't get tougher from here because it got tougher, right?
It got tougher quickly.
You could just as easily lose 5% in stocks or bonds. Pick your poison. Either of them really stunk it up for a sustained period of time,
right?
Which is rare in global markets, right?
Yeah, it's been a rough Q1, and it even started before the beginning of the year, actually. Yeah. Even going back to the end of last year, really volatility and the market sell-off really started around Thanksgiving last year. And it wasn't yet about Russia or geopolitical tensions. It was more about U.S. monetary policy and the Fed tapering and all of that.
Right.
So things were already tough in markets coming in.
We got double-fisted like a turkey on Thanksgiving morning.
I remember that.
First it was Fed, right?
Mm-hmm.
First it was interest rates are coming up. This inflation is a concern. Mm-hmm. And then before the next trading day, Omicron, right? Our first glimpses of Omicron, and it seemed to take about 2 weeks at most to basically hit the entire globe,
right? So it was already tough coming into the year, and then obviously with Q1, the war in Ukraine, and the market reaction. And really, like you alluded to, it's been a tough quarter because there's been no real place to hide
smaller pockets to hide.
But
the larger asset class is rough.
So typically when you have a typical market sell-off, more defensive assets such as bonds will act as a buffer and will do well. Here you've got both inflation concerns and higher interest rates, and you've got a sell-off in the equity market, right? So the average diversified investor is invested in what? Stocks and bonds, right? That's your 60-40 or whatever your exact asset class mix happens to be.
Sure.
And if you look at the performance in Q1, really you've got maybe down 5-6% for stocks, global stocks, and the same for bonds. And that's pretty unusual, right? So that's a combination of really poor performance that's made it really tough for a lot of diversified investor.
Right. Well, I mean, in a very low interest rate environment, which we've had for forever now, it seems like, right? The thing that you tell your clients is, hey, you still got to own bonds, not for yield, not for the income that they're going to throw off, but for the protection they'll give you in a challenging stock market, right? So, and then this last quarter came around, and they didn't do their job, so to speak.
Right.
And for reasons that
Absolutely.
I'm sure you can provide very intelligent analysis on. But for just everybody out there, it's one of those periods where you don't get the what we would call negative correlation between bonds and stocks.
Absolutely.
And we've had positive correlation between bonds and stocks over, during periods of time over the last few years, but
Sure.
it's generally been because the Fed's cutting rates,
They were both
and
going
interest rates
up.
are going down,
Right.
and so people want to buy bonds and stocks, right?
Right. So, I mean, correlations, which is the extent to which two asset classes move up or down together, is not stable over time, right? And so whether it's positive correlation or negative correlation, they don't stay the same all the time. And so, in any given year, you could have very high degrees of correlation between two asset classes or not. So I think there are still really fundamental reasons why stocks and bonds are not very correlated. But it's true that in recent years, even before all of this started, like treasuries and stocks have been more correlated than they've been in the past. And I've often spoken about the market being a Fed-driven market. And so
Right.
the Federal Reserve pushing down interest rates, bond yields go down, bond prices go up, stock market goes up, right? And that sort of dynamic's been in place for many years, really. So you're already having an environment right now for the last few years where stocks and bonds are more correlated than they normally are. Right. And it's worked in investors' favor, for a long time. And in Q1 this year, it's worked against investors for the most part.
Yeah. So, I mean, so would you say that it's fair to say that over the last few years, more of the government policies to guide and, smooth out the economic cycles have been, that the central banks of the world have played a greater role than they normally would, as opposed to fiscal policies that governments usually undertake, also, right?
Absolutely.
Yeah, I mean, I think that hits the nail on the head, I think.
Well, and I think prior to COVID, so prior to 2020, it was all about monetary policy. And what changed with COVID is that, fiscal policy also became incredibly loose. So you used to have incredibly loose monetary policy and, somewhat neutral fiscal policy. And after COVID, you had both being extremely loose. And I think that played an important role in the change in the inflation narrative, getting us to where we are now, which is an environment where inflation's running hot. And so that's going to put pressure on rates. And you're starting to see a lot of the market dynamics that we've had in place for the last few years kind of unravel here.
Right. Now, a lot of the fiscal policy that was supposed to continue in the Biden administration kind of got watered down through, opposition, of course, right?
Right.
We didn't get the $6 trillion infrastructure bill, right? We got something that was a fraction of that.
Right. But we still got multiple rounds of,
But enough free money floating around.
Right.
Enough, here's a check from the government just because it's COVID times. Right.
I mean, the scale of the government intervention through fiscal policy has been, greater than even anything we had after the 2008 crisis. Right.
Right.
So, even though it maybe wasn't as ambitious as some politicians would have wanted it to be, it still had a really profound impact.
Pretty historically, relevant amount of loose policy.
Absolutely.
Free money and FPP and all of that, right?
Absolutely. And I think to some extent, as I've said many times, the market is addicted to it, right? So, and at the end of last year, you started to see all this talk about tapering. Obviously, that's been an important theme. So volatility was already high, and then you got geopolitical problems to add on top of that this year. And so
exactly this year, it's taken the central bank policies, and you've still got COVID issues.
Yep, that's true.
And then on top of that, we have Putin trying to put the old Cold War band back together again, trying to push back the Iron Curtain, try to expand that boundary of influence a little bit more.
Right. So what has worked in Q1? Has anything worked?
Yeah, absolutely. Things especially I think, predominantly in response to inflation, right?
Mm-hmm.
Is that the classic things that you want to own during inflationary periods, and that would be commodities, right? And obviously Russia being the number 2 world producer of oil has anybody that's listening here probably had to fill up the tank at some point in the last couple of days or weeks, and is not happy about it, right? So, owning things like oil and gas derivatives, owning things like food commodity prices are up really across the board, right? Metals, all up. Gold's done well.
Absolutely. And I think it's been a perfect storm really for commodities because you already had the inflation story that tends to favor hard assets and commodities. And then you've got the geopolitical tension on top of it that also favors, oil and energy because it makes it harder to source them. And so if you look at sector performance so far this year, it's really quite amazing that the best performing sector is energy. And it's not, by a little bit.
Right.
It's not like it's like energy and then daylight and then there's number 2, right? So I see through the first quarter, energy, if you look at sectors within the S&P 500, energy was up 37.7%.
Yeah.
The second best sector,
37%.
yes.
I mean, that just sounds like a misprint, but that's
I know, right? That's why I'm looking at it. No, it is a real number. And the second best sector was utilities.
Sure.
But you know what the performance was?
Something probably more around 3 or 4%.
It was 4%.
There you go.
Right?
Yeah.
So pretty dramatic. The extent to which energy outperformed just about everything else.
Yeah. I mean, utilities being the one thing that basically gets an automatic inflation pass, right? I mean, like you get to pass, you get to hike your rates as energy rises,
Right.
And pretty much 100%.
Right. So, and what's interesting about it is, I mean, if you had to pick one unloved sector in the S&P 500 for the last decade,
energy.
It would have been energy.
Absolutely.
Right? I mean, no one likes energy. People have been reluctant to invest in it for many, many years. And it's been a just terrible performer, right? So all this frenzy of, tech stocks that we've had in the last decade, if you were an energy investor, you missed out on this whole thing. So
not a great quarter for ESG compared to just basically eschewing cultural and moral value and just going straight to producers of coal and petroleum. Right.
Right. So I mean, and there are reasons other that are not investment related why people don't like to invest in energy stocks, and
right.
we alluded to one of them. If you have environmental concerns, obviously, you would maybe want to stay away from energy regardless of how it performs. And I think that trend has also contributed to energy being so unloved. Right, over the years. But the fact is that it remains a absolutely critical strategic sector of the economy. Right? The economy runs on oil to a large extent. And that's the reality. And
I mean, energy got the double whammy because in my mind, over the last decade, I mean, I've written about how the sectors have shifted within the S&P and how energy's been the biggest loser. Right. It's had the greatest amount of shrinkage as technology and communication services and consumer discretionary have boomed. Right. So there's the natural index. I mean, as we become more index-related investors and think about the trillions of quadrillions of dollars invested in both ETFs and index mutual funds, that just meant that much less was going to Chevron and Exxon and that cohort because they became a smaller percentage of the S&P. So the index money didn't flow to energy.
Right.
And then on top of that, then you've got the rise of ESG, and you've got ESG index ETFs, which are essentially like if you had a large cap US ESG fund, it would be like pretty much the S&P X energy and a few other actors, I suppose, right?
Yeah, and energy started from a really low base. And look, if you were to go back several decades, right? If you go back to maybe the very late 70s or the early 80s, at the peak, I think energy was around 30%, maybe a little bit more than 30% of the S&P 500 back then.
Wow.
Now, fast forward to 2020, I think it dropped to as low as maybe 2.5%.
Yeah.
Somewhere in that area.
That's profound.
So that is a profound shift.
Right. And what else happened in 2020 that was kind of interesting and unique to energy?
Oil futures going to zero?
Yeah. I mean, you literally had a commodity trade its futures at zero or even negative, very for just a little blip, but it happened.
Right. And so, there's a few other things that have worked well for investors. I mean, energy's done great. I would say going back to ESG, I think the market is perceiving something that looks like an energy crisis now. And I think actually, if you look at renewable energy producers, they've not done so badly this year. They've actually done okay.
Been volatile.
They've been volatile, but they've done pretty well, I would say. They've done better than many other sectors, and I think that's because people are starting to seriously consider the fact that with traditional energy prices going up so much, it's time to maybe start looking at alternative energy producers and maybe the opportunity cost of those projects has gone down a little bit with traditional energy prices going up so much.
Right. I mean, we always think about this, as consumers, everybody's, excited to see more electronic vehicles on the road. But then, on the practical side, you have to also remember that, you're not going to fill up at the pump, but you still have to charge those things, right? And that's not free. And that's using some fossil fuel. It might be natural gas. It might be coal. But at the end of the day, the more that price of gas rises, the more that Tesla starts to look like a better economic choice, right? And for Europe, obviously, with there's no question in the world that a lot of this conflict is about Russia's ability to exert direct force over the countries that control, parts of the pipeline that they want into Germany, right? And Europe has to come to terms with this idea that if they're truly going to not want to do business with Russia, that puts a premium on more alternative sources of energy.
Right. Absolutely. And so I think overall what we can learn from Q1, I mean, we had kind of a heart attack moment in markets when we first heard about the invasion of Ukraine, and there was a massive sell-off. I would say once again, however, investors who were patient and did not panic ended up being rewarded by a nice rally or strong bounce really at the end of the quarter. So we'll have to see if that is sustainable. But once again, you've seen the value of not being overly reactive and not panicking, right? You don't want to be selling when everybody else is. So that's one takeaway. And the second takeaway, going back to our discussion about different sectors and pockets that have done well, again, you can see even in a quarter where stocks and bonds have both done poorly, there's still value in diversification, it's a little less obvious.
Right.
But as the environment shifts, there are winners.
Yeah.
There are still winners.
Some value in sophistication, if I dare say so, right? It sounds self-serving, but the idea of, owning more than just the most obvious and traditional asset classes can play a role in your portfolio, because, and it's always on full display when bonds and stocks are doing poorly, right? Jim Cramer, he's a bit of a goofball, but he's not wrong when he says there's always a bull market somewhere, right, on his show.
Right.
There is, but usually he's not going to help you find it until it's too late, and then he's going to be all over it. But that's beside the point. But if you hear from certain brilliant people, and there are people who consider themselves pretty brilliant out there, that will tell you that they don't think commodities are an asset class that's investable. That's a very big and bold and horribly incorrect statement. But you do hear some pretty respected people that will voice those types of opinions. And really, I think this is the kind of market that can humble everybody, right? Even if you're using commodities, it was still, a tough slog. But it displays the value of having a mousetrap that's got a little more, a few more moving pieces than just, again, that traditional balanced portfolio, that, Fidelity balanced, type approach, or the, having B&D, VT, type of two-dimensional, portfolio.
Absolutely. And I think, we try to look a little deeper or work a little harder to find pockets of diversification. And I think that's worked relatively well for us this quarter overall. And sometimes you do need to be a little bit more creative in terms of your choice of assets and your choice of funds. And sometimes holding things like gold or commodities or sector specific equity funds can have its benefits, right? And it's not necessarily done from a speculative point of view. Oftentimes it's just as a source of additional diversification, right?
They're assets that can play defense when bonds don't want to, right? And another thought just occurred to me, Syl, that like a lot of people who are supposedly pretty smart have been, throwing out statements like Bitcoin has replaced gold as, that Bitcoin is the new gold, right? How did Bitcoin do during the quarter?
Not great.
Not great, right?
Not great.
I mean, so again, it comes down to correlation, right?
Right.
Fearful people and nothing like armed conflict can cause, immediate fear.
Yes.
And rightfully so, right? But
that will bring everyone back to earth.
Fearful people like gold, right? And but if you look at Bitcoin and stuff, the correlations are not negative with stocks. The correlation is in fact quite positive with stocks.
Yep.
Right.
In particular with tech stocks,
NASDAQs. Yeah.
It is a new technology. So
and I'm not saying that anything against it. I think that the whole blockchain area of technology, may play a very important role in the future, right? But don't own it thinking that it's now the new gold. And instead of gold, I'm going to own Bitcoin, because that doesn't make any sense to me.
Yeah, no, that I mean, that's a nice idea, and you can make a pretty elegant argument as to why that may be the case. But in practice, that has not materialized.
Yeah, I mean, prove it with market data. You can't.
Right. Absolutely. So I think we're getting close to our time being up here. So we're gonna wrap up. Again, a very eventful quarter, but overall a quarter that has continued to reward diversification. And for any clients listening, please don't hesitate to reach out, get in touch if you want to discuss any of these topics, and anyone else listening as well. If you wanted to have a chat about maybe your portfolio and discuss the way that it's behaved over the quarter and get our feedback and our input, we're always happy to have a chat.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.